Okay, let's unpack this. Have you ever looked at a company's earnings report and just felt a bit overwhelmed? All the jargon, the numbers.
Oh, absolutely. You're definitely not alone there.
Yeah. But what if we told you there are always, fascinating stories hidden in those documents, crucial insights? Today, we're taking a deep dive into Bank of America's second quarter results for fiscal 2025.
Right.
Our mission. Cut through that complexity. We want to reveal why these results were seen as better than feared by some pretty sharp minds on Wall Street.
Yeah.
And what that actually means for the bank and, for you, our smart listener who keeps an eye on the markets.
And what's fascinating here, I think, is how just one analyst's perspective can really shape how the market feels.
Definitely.
We'll be drawing pretty heavily from a Goldman Sachs report, the analyst Richard Ramsden. It gives us a really good look at Bank of America's performance.
Okay.
And we'll look at not just what happened, the numbers themselves, but why it matters. Trying to give that broader context, help you connect the dots a bit.
Connect the dots between the bank's health and, well, the wider economy. So the big question coming into these results was, could they really beat expectations? It's been a pretty tough environment.
Right. A lot of uncertainty.
Let's dive into those headline numbers then, because they told quite an interesting story right off the bat. Their reported earnings per share, that's basically profit per share, right?
Exactly.
It aligned perfectly with what the market expected, 89 cents.
Spot on consensus.
And their core EPS, also 89 cents, but that was actually just a tiny bit shy of Ramsden's own forecast. He was looking for, 91 cents?
Just slightly more bullish, yeah. 91 cents was his number.
Okay. And then there's the core pre-provision net revenue, PPNR. It's that key measure of operating profit before they account for potential loan losses.
That's the one.
That hit $9.5 billion. Pretty much bang in line with street expectations. So, it seems like a solid start overall.
Indeed. And according to Ramsden, what really supported these results were stronger core fees and stable operating efficiency, basically how well they managed their costs.
Right, cost control.
Even though their net interest income, the NII, was a little bit lower for the quarter.
Okay.
So it kind of speaks to the bank's resilience, In this dynamic environment, they managed to perform pretty well on multiple fronts, even with some headwinds.
Now, here's where I thought it got really interesting in the report. Their outlook for that net interest income, the NII, for the second half of 2025.
Yeah, the guidance.
Right. Even though they factored in 2 fewer rate cuts than they previously thought.
Which is significant.
Their NII guidance stays surprisingly strong, like $15.5 to $15.7 billion for the fourth quarter. Right. How are they pulling that off? Everyone expected rates to be a bigger challenge.
Well, this raises a really important point about where that future NII improvement comes from. Ramsden thinks it's going to be propelled by a pretty significant step up in asset repricing.
Asset repricing. Okay, explain that a bit.
So essentially, it's the bank being able to reset the interest rates on its assets, like loans as they mature or reset. They can align them with the current, presumably higher, market rates.
Oh, okay. So getting better returns on their existing loan book as rates change.
Exactly. Think of it like refreshing the portfolio to capture better returns. We're talking about a jump from like $100 million worth of that effect in Q2 to maybe $225 million per quarter in Q3 and Q4.
Wow, that's quite a jump.
It is. And this ability to keep that NII guidance strong, even with fewer rate cuts expected, that's a key insight. It shows BOFA isn't just, passively reacting to rates.
They're actively managing.
Right. They're using sophisticated strategies like this asset repricing. It suggests they're being agile, strategic.
That asset repricing sounds like a pretty powerful tool for them right now. But I wonder, is that sustainable, like long term? Or are there limits? What if rates suddenly started falling?
That's a great question. And it's definitely something analysts are watching closely. Repricing is powerful when rates are stable or rising.
Yeah.
If they fall significantly, that could become a headwind.
Right.
For now, though, with rates where they are, it looks like a key strength. But you always need that vigilance, that eye on the longer-term rate path.
Okay, makes sense. Shifting gears a bit then, let's get into their core business. Loans and deposits. The bread and butter of banking, right?
The fundamentals, yeah.
Loans grew 1% sequentially. That's quarter over quarter. With commercial lending up a healthy 5%, that seems pretty strong.
Yeah, decent commercial growth. Consumer lending was up 1%.
Okay. And deposits?
Deposits were actually 1% above what people expected. And deposit costs, what they pay out on deposits, barely moved, down just 1 basis point.
1 basis point. That's tiny. 100th of a percent. So very stable funding costs for them.
Extremely stable.
So overall, that sounds like pretty solid growth in the core business.
The volume growth is good, yeah. But if we connect this back to the bigger picture, there's a bit of nuance in the yields on those loans, the average interest rate they're actually earning.
Okay. What happened there?
They actually declined by 7 basis points, which meant they underperformed what analysts expected by about 6 basis points.
Huh. So even with loan growth, the profitability per loan slipped a bit.
Exactly. It shows that even with growth, the actual return on those loans can be squeezed by the rate environment, maybe competition too. So yes, more loans, but slightly less profitable on average for this period.
Got it. Okay. Moving beyond lending.
Yeah.
Fee income. That also beat expectations, right? By about 0.5%.
Yeah, fee income looked good overall. The real standout there, though, was trading revenue.
Right, you mentioned that. A huge surge.
Massive. Up 15% year over year, way ahead of what even the company guided for. Someone in trading definitely had a good quarter.
No kidding. But here's the flip side, kind of surprising. Investment banking revenue. Despite expectations being pretty strong, it still fell. Down 7% year over year. What's that telling us? Seems like different parts of the financial world are moving at different speeds.
That's a great way to put it. The strong trading suggests, active markets, maybe good risk management in their trading division, perhaps capitalizing on volatility or client activity.
Okay.
But that continued slide in investment banking, that's definitely something to watch. IB includes things like advising on mergers, helping companies issue stock.
M&A, IPOs.
Exactly. And that decline suggests that corporate deal-making, the M&A and capital market side, might still be kind of sluggish.
So corporations are still maybe a bit cautious despite other economic activity.
It could signal that, yeah, a bit of hesitation perhaps in those big strategic moves.
Okay. So we've covered a lot of the positives, the resilience, but any deep dive needs to look at the areas under scrutiny too.
Always. No report is perfect.
The core efficiency ratio came in at 64.5%. That was slightly worse than expected, right? A higher number is generally less efficient.
Correct. And core expenses were $17.2 billion. That's up 5% from last year, and actually above the bank's own guidance range for the year.
It kind of reminds me of trying to manage a household budget. You're always trying to keep those expenses from creeping up. Is it similar for a huge bank, just on a way bigger scale?
That's a perfect analogy, actually, yes.
So what does this tell us about their operational discipline? What did Ramsden, the analyst, make of it?
Well, that efficiency ratio, how much it costs to make $1 of revenue, is key. Higher can mean less efficient, or maybe they're making investments. Ramsden definitely flagged it.
Yeah.
He specifically asked for clarification on whether their full-year expense guide is still valid, which is crucial, right? Because if costs are climbing faster than planned.
That hits future profits.
Exactly. Investors really want to see those costs kept under tight control.
Understood. Okay, what about the health of their loans? Credit quality? Provisions were actually 2% below what the street expected.
Right. Slightly less set aside than anticipated.
And the reserve build, that's the money set aside as a buffer for potential future losses, like an insurance policy. That was about $67 million, pretty much in line with forecasts. But net charge-offs, those are the loans they've basically given up on collecting.
The write-off.
They actually increased 5% from the previous quarter and came in 1% above what analysts expected. So should we be concerned there? Is the loan book getting shakier?
Well, the analyst, Ramsden, noted he didn't see signs of significant credit quality deterioration, so that's reassuring.
Okay, good.
However, he did emphasize that he'd be watching the pace of those reserve builds very closely, which raises that important question, and in this uncertain economy, how big does that buffer, that reserve, really need to be?
Right. Are they building it fast enough for what might come?
Exactly. The current numbers aren't flashing red alarms, but the vigilance around those reserves is definitely key going forward.
Makes sense. Okay, lastly, capital return. Always important for shareholders. Bank of America bought back $5.3 billion in stock during the quarter.
Yep, significant buyback.
Their CET1 ratio, that core measure of financial strength, capital versus risk.
Right. Common Equity Tier 1.
It declined a bit to 11.5%. But that's still pretty solid, right? Like 1.5%, 150 basis points above the minimum they're required to hold.
Yeah, still a very healthy buffer above the regulatory minimum. It signals stability to investors, to regulators.
But the analyst is still asking for more details, it seems, on how they plan to deploy capital. especially with potential changes to capital rules maybe coming down the pike.
That's right. There's always focus on capital plans. How much goes to buybacks, dividends, versus reinvesting in the business or holding more capital for potential regulatory changes. Ramsden wants more color on that strategy going forward.
So bringing it all together, what does this mean for you, the listener, in the bigger picture? What are investors really watching now?
I think it means investors are keenly focused on a few core things. First, that NII path. How sustainable is that boost from asset repricing? Second, how well does the bank manage its operating leverage in the back half of the year? Can they turn revenue growth into even better profit growth efficiently, especially given those expense questions?
Right, the efficiency piece.
And third, can that really strong trading revenue be sustained, or was it more of a one-off good quarter?
Got it.
Those are really the key indicators for how BOFO navigates, both the interest rate shifts and any evolving regulations, and that ultimately impacts their profitability and stability.
So to sum up our deep dive into Bank of America's Q2 fiscal 2025 resilience, that seems to be the name of the game here.
That's fair.
Strong fees, that positive NII outlook for the second half, those are definite pluses, even with some lingering questions around expenses and that kind of mixed bag on investment banking. It's a complex picture for sure, but ultimately, maybe that better than feared label makes sense. It shows the bank finding ways to adapt to perform, even in a pretty challenging environment.
Absolutely. And this whole discussion, it kind of raises an important question for you, the listener, to think about. As interest rates are still such a huge factor, right? And the regulatory landscape keeps shifting. What does this deep dive into just one bank, Bank of America, what does its performance reveal about the broader stability, the future direction of the whole banking sector?
Good question.
Think about how these individual company results, like we just unpacked, can really be almost like a barometer for the wider economic environment that you experience every day. Something to chew on.